My guest today is Chris Younger. He's the co-founder of Class 6, which is a mergers and acquisition firm. They help people sell businesses and maybe even buy businesses. I don't know if you do buy side, but we know you do sell side. And I like to bring folks on to talk about this because it's really important for you to know what it takes to get your company what we call sale ready. Whether you're going to sell or not, it's the place you really want your business to be for a whole host of reasons, and we'll probably get into that today. But first, let's bring Chris on the show, and we'll start our conversation. Hey, Chris, how are you today?
Good, good. Thanks for having me on.
It's my pleasure. Thank you for joining us. So let's start with this. You wrote a book called Author of Harvest: The Definitive Guide to Selling Your Business. So, what is, in your opinion, the most important thing somebody needs to do if they're getting their business ready for sale?
I think there's a lot that goes into that, as you well know, in terms of getting a business ready to market. I think there's a couple of different pieces to start with. One is just understanding what the owner's objectives are, and then benchmarking that against where's the business today. And hey, if there's a gap there, what's that plan or what's that process to get it from here to there? Usually, what we see the most significant risk for businesses is that the business is way too dependent on the owner, and that'll destroy value, right? Because it creates risk in the eyes of a buyer if the business, whether it's the owner's the key salesperson or the key product developer or the primary person doing delivery, that'll certainly limit the value of the business. And so what we typically work on first with business owners is just, hey, how do you build your team? Which not only makes the business more valuable, but hopefully it gives that owner more of the life that they want, so they're not working 80 or 90 hours a week.
Yeah, I find that we call that create operational freedom. And
Exactly.
what I've learned over the years is that the owner has to be out of the day-to-day operations of the business. And there's two reasons for that. One is it keeps them from getting burned out, which actually, in the long run, if you do that successfully, really often relieves that need to sell the business.
For sure.
So, I mean, I don't know about you, but I've done this several times where we've gotten people who come operationally free. Their business starts making a lot more money. They're spending a lot less time running the business. And I say, okay, let's bring the business to market. And they look at me like I'm out of my mind.
Yeah, we always tell clients we really want them indifferent to whether a sale happens, because that means all options are great. And if a deal happens, it's going to have to be a fantastic deal to convince them to leave what otherwise is a pretty good situation for them.
Yeah, I mean, there's lots of reasons to sell businesses. And, I was talking with a client just before we went on this podcast. And he sold his business to his 36-year-old son. It's got a market value probably of $8 to $10 million. And he wants to get out of it because he doesn't want to work, 7 days a week. And I said to his father, I said, we could get a competent general manager, and you're making enough money to pay somebody to do that. And you'd probably relieve a lot of pressure. And maybe, at 36 years old, with over $1 million in free cash a year, it's pretty hard to match that when you sell your business.
It is, yeah, you're definitely going to trade a highly concentrated, usually much better return asset for much more diversified portfolio, but much lower returns for sure. Yeah, I think for most business owners, successful business owners, that'll be by far their best investment over their lifetimes for sure.
Yeah, well, I mean, private businesses are worth a lot while you run them. They're often not as worth nearly as much after you stop running it.
Yeah, right, right. Yeah, you're going to have to convert it into cash at a really good rate. So
That's a hard thing that can be a challenging thing to do. So when you prepare a business for outside scrutiny, what do you need to do? Because I think that's a good question, and we should all be thinking about that all the time.
I think about it in two or three different buckets. One is just getting everything in order. Today, what we see in transactions is the level of diligence that buyers are performing is probably twice as extensive as it was just 3 or 4 years ago. They're hiring firms to come in and assess all kinds of different facets of the business, and so part of it just getting the business ready to survive all of the asks and inquiries and document requests and follow-ups and all that. And if I had a dime for every client that told us ahead of time that their business was the cleanest we'd ever see, the financials were in perfect order, and after a little bit of work, you discover, yeah, there's probably a little bit of work that we need to get done on those, to get them ready. And then the second piece, I think, is really around kind of identifying, hey, what are the Achilles heels in this business, right? What are the issues that a buyer is going to uncover? We use a bunch of assessments in our practice to identify, hey, what are those issues going to be? It's trying to give that owner the test ahead of time, because regardless if you're going to be able to fix them or not, you're going to need to be able to answer the issue and deal with, hey, what is it that a buyer's concern is going to look like, and what's your story around that? And then the third piece is, hey, if there are things that you can do to eliminate some of those risks, then hey, let's get to work on those before you go to market. And I would say the final piece for most buyers, right, they're buying the future, and so putting together a really credible growth plan that's got roots in historical performance and is not too much pie in the sky, that will create value for the business owner, because that helps the buyer see, hey, there's future opportunity and future growth in this business, so I'm willing to pay more for that.
Yeah, I have found that in selling businesses, what you just described is what you'll go through with a private equity buyer, likely not go through with a competitor because they don't have all that stuff, nor would they think it's really important. I mean, this is one of the things. I just sold a business recently to private equity. It was a $1.8 million managed services business with an
Mhm.
$800,000 profit. And they went through all this garbage that I kept saying to them. I said, "You're buying a really small business. Why are you spending almost as much as the purchase price on due diligence?" And they kept saying, "Well, this is what the bank requires," which is pure BS, frankly.
Yeah, for private equity in particular, right? They've got folks that they're accountable to, and I think it's gotten to the point now where the due diligence reports that they have to get, it's almost no one wants to be the guy in the room, right, when something goes wrong and they didn't get the report from whatever the outside third party was to validate it. So it's a little bit of CYA.
Yeah, and well, my experience is most of these guys don't know how to run businesses anyhow, and they're
That's
gonna
probably true. Yeah.
they're gonna ruin it once they take it over. But that's a different conversation.
Yeah.
I'd
Yeah.
like to talk for a second about what I call mock due diligence, which is when you take a client through what a buyer is going to hopefully not look at, but might look at. And um, what's your methodology for doing that? And due diligence, by the way, is where the buyer has the right to look at everything in your business to find out if it's worthwhile for them to buy. They will sign a non-disclosure agreement and they will go through your business and ask you all sorts of questions. And there's a good chance the first time you go through this, you might take your business off the market, like I did, because
Yeah.
you're going to be insulted. So just get prepared for that.
Right. Right. Yeah, I mean, the process of examining your own business and understanding where you might have exposures. I mean, I think that's a good practice regardless of whether you're going to sell the business or not. What business owner wouldn't want to have a business that is more scalable and more predictable, which is really what buyers are looking for, right? They want to eliminate, potential problems downstream. And so that's what they're looking for. That's what they're trying to identify. And that can show up in a variety of different contexts. One is, hey, are the financial statements accurate that they're looking at? Because that's obviously a big piece of how they're coming up with their valuation and how they're assessing the health and prospects of the business. But they're also going to look at your team. They're going to look at your contracts. They're going to look at your customer base. They're going to look at your supply chain. They're going to look at your intellectual property, all those different pieces. And those are, it becomes uh, again, I think it's just a good practice to do a self examination and understand. hey, where do we have potential issues, right? Where do we have potential roadblocks that could get in the way of a deal getting done or reduce valuation? Again, we have a series of tools that we use. We've developed a tool called Copilot, which is, ask about 200 questions, and all it's designed to do is just issue spot. So that, hey, if something pops up with one of those questions, hey, we know to dig further and see how big is that issue that is potentially arisen.
Yeah, that makes sense. And how often do you find owners actually are interested in fixing the problems that you uncover with your mock due diligence?
It varies, right? I think some owners, may not see the need for a change. There may be risks that an outsider would see as significant that they don't necessarily perceive, and that's part of our job is just to help them understand. Hey, this is how the outside world is going to look at the business, and obviously, they hold all the cards in terms of what they want to do with their own business. This is more just, hey, here's what to expect. Um, and I would say again, at least for the clients that we have, most of them are, they are dedicated to trying to address the issues in the business to the extent that they can. I do think that um, oftentimes business owners who've been managing a particular risk for years and years and years are just way more comfortable with that risk than an outsider would be. And so sometimes it's hard for them to really appreciate how an outsider is going to look at that risk and the impact on valuation.
So, one of the things that I often will encourage somebody to do is, again, the folks we work with generally are under $10 million in sales, and finding a good financial buyer can be a challenge for that. A strategic buyer, which by definition is a competitor, is often a better, and they'll take a look at the risk in a similar manner that the owner does because they're in the same industry and they understand what that industry is about. So if there's a risk, I mean, for example, if the owner is involved in day-to-day sales and they have a sales team, they're likely not going to be as concerned about that as a financial buyer who's coming in and doesn't have a team that they can bring in or integrate with right away. Do you have that conversation with your clients about who the right buyer would be?
Yeah, all the time, right? You're always trying to explore with the owner, hey, what are their priorities, right? What is it that they're trying to accomplish? And, that can push them one way or the other in terms of the right type of buyer. We uh, again, we typically are working on larger deals, but I think from a buyer's perspective, even if it's a strategic, if most of the relationships with customers are resident with that owner, that's gonna create some anxiety for them. So in other risks, to your point, if they're kind of endemic to a particular industry, I don't disagree. I think most industry buyers are going to, they're already comfortable with it. We sold a waste hauling company at one point, which obviously it's got lots of potential safety risks. A lot of the financial buyers had a hard time getting comfortable with the fact that there's, I mean, quite frankly, a risk of death, right, in their industry. They have 300 trucks on the road, every day driving however many miles. Your odds of having something bad happen are pretty high. Whereas the industry folks, the waste managements of the world, they understood that risk and got very comfortable with it. So a lot of times it'll just depend on what's the character of the risk, and hey, with that particular buyer, do they think they can mitigate that risk?
Yeah, that's absolutely true. What about internal sales? Do you guys ever get involved in that?
Yeah, we have a lot of clients that show up and they would love to sell the business to the management team, and which I think is it's a great strategy. Most times, unfortunately, the management team, when it really comes down to, hey, they're going to be signing on a note that's got a personal guarantee, that's got all their assets at risk, and that they now are not taking a salary, they're the last person paid. I would say 8 times out of 10, they get pretty nervous and tend to back away. I like to say I think 1% of the world's population is probably suited to be a business owner, given the risk tolerance that they have to have, and and kind of tolerance for pain, as I like to say. And a lot of folks that are employees, I think they may romanticize what it means to be an owner, but it is often challenging for them to kind of get comfortable with that level of risk. But it is if you can make it work, it's awesome, right? I think it's a great reward for the team and a great opportunity for them to make their own wealth, which is terrific.
The challenge I find is, and this is usually a 3 to 5 year process, is we have to convert the new owner buyers who are managers right now into having an owner's mentality.
For
And there's
sure.
a specific process we take people through to actually help get that done.
Yeah.
If you don't do that, and you say 3 months before you want to sell your business, you go to your management team and say, "Hey, I'd like you guys to buy this, and here's all the risks you're going to take." There's a pretty good chance they're going to say no. But if you
Correct.
start 3 to 5 years ahead and you identify potential buyers, you say, "Okay, here's the process we're going to go through to get you ready to become the next owners," you're likely going to have a sale. It takes a lot more time, is what I'm
For
saying,
sure. Yeah. No, no,
than
that
doing
makes total
than,
sense.
than doing a third party sale.
Yeah. Yeah, for sure. For sure.
So that's one of the things that we find is in the level that we're at, especially if the owner is intimately involved in the business, or there's no recurring revenue like with construction companies.
Yeah.
They're essentially not saleable to a third party.
Exactly. Exactly.
So you have to sell it internally, or if you're big enough, you can do an ESOP, an employee
Yep.
stock
For
ownership
sure.
plan.
Yep.
In fact, the largest construction company in Vermont they ended up doing an ESOP because they could not get an offer that was even close to fair market value. And this company was doing close to $1 billion a year in sales. So
Yeah.
it's
Yeah. Those are, to your point, they're tricky to get done. And, a lot of times, especially at that size, if they're doing big bonded projects, that gets in the way of financing that a lot of buyers want to use. And so that makes it much more challenging. So, not surprising.
not surprising at all. Um, so I'm curious about this. You cultivate high yield investments. What do you consider a high yield investment?
Well, I don't, yeah, in terms of kind of high yield, I think it's more around, hey, what kind of return is the business owner going to get on their investment of time and energy in this type of process?
Yeah.
Um, and it's really around, hey, and I think the time that an owner spends on working on risk in their business and thinking about growth strategies more in a more disciplined way, I would argue that's going to be the best time that they ever spend in their business. In terms of return on investment, as I think about, hey, what are the limited resources for an owner? Usually it's time and money. And so, I think the job of the owner is, hey, how do I invest my time and money in the most efficient way possible? And again, based on what we see is just, hey, spending your time on making your business more scalable, making it more predictable, kind of cutting risk out of it. Well, at least our experience has been we've seen dramatic returns on investment of that type. And so that's typically what we're referring to as high yield, I guess.
Yeah, and I think the key to that, which is something we already talked about, which is making the owner operationally irrelevant in the day-to-day operations of the business, now will give them time to work on what we call the 5,000 per hour job, which is, what can you do? Too many owners spend the vast majority of their time doing stuff they could hire somebody for $30 an hour to do,
For sure. Yeah.
or
We have
just or just learn how to delegate effectively, which again is a problem for most business owners.
Yeah, we have an exercise and a tool we call the 80/20 exercise, which is really helping an owner understand where their time's going. So you track time for 2 or 3 weeks and get a sense for where is their time being spent. And then what you really want to analyze is, hey, let's dissect those activities and prioritize them in order of kind of what they like most to what they like least, what they're best at to what they're worst at, and what adds the most value to what adds the least value. And then that gives them at least a roadmap for some of the activities that they should either be eliminating because it's not adding a lot of value, or to your point, delegating, because there are people, and most owners have a hard time with this initially. They think they can do all of it great. What we've learned is there are a lot of people that can do a lot of what they're doing a lot better than they can. So, and that's the goal, right? Is to get them out of those activities.
Yeah, absolutely. They it's really interesting. I find that buyers are more concerned about owners being involved in the tactical issues of a business than the strategic issues.
Yeah.
If you make yourself operationally irrelevant and you're a strategic wizard in making your business as successful as it is, for some reason buyers in their due diligence completely ignore the strategic part of what makes a business great.
Yeah, it's amazing. Talking about private equity. Uh, we've watched this movie over and over again where, you have an entrepreneur who's been very, very successful. And, I like to say, most successful mid market businesses, they're successful because that owner has figured something out and they've been
Yep.
creative in how they've gone to market and they've been thoughtful and they've figured something out. And it's amazing to me how quickly a private equity firm or a new investor is to ignore the founder. In my prior life we did a roll up where we acquired 27 communications companies, and one of the very first things that I learned was you want to listen and encourage and support those entrepreneurs in the best way you can, because they know how to make a successful business. That's why you bought it. But oftentimes a buyer might show up as the smartest guy in the room and ignore what the founder has, spent years learning, and by and large to the detriment of the business.
Yeah, I find that's especially true with smaller private equity deals. The big ones, they've got all the systems and processes in place. But if you have a business that's $20 million, it's always dependent on what the business owner brings to the table.
For sure,
It
for sure.
sometimes it's tactical, but if it's strategic, that's where the business has become unbelievably successful. And the reason is the owner, you mentioned, the owner's figured something out. I tell this story all the time is that back in my very early days in the vending business, my mentor had built a $40 million food service company in Charlotte with a margin of 14%, where the average in the industry was 3%.
Yeah, it's pretty good margins for a food service business.
Yes, and a national company bought him out, paid him a lot of money. And about a year and a half after the deal was done, the CEO of that region called him in and said, Shields, this office isn't big enough for both of us, so you're going to be leaving right now. This was a guy that they should have picked his brains for the entire company. It was $1 billion company that bought him. He had figured out how to get a 14% bottom line. You had a 3% bottom line. Why aren't you picking this guy's brains? And he was absolutely devastated because he wasn't expecting it.
Yeah,
And that
yeah.
happens more often than not.
Yeah, again, as we talked about, entrepreneurs are successful usually for some kind of unique reason, right? I mean, they have figured out a niche or figured out a way to process things or an operating process, whatever it is. And to your point, I think it behooves any investor to really listen closely.
Right.
Obviously, I'm sure there are things that they can do to improve it, but to ignore that founder, I think, is to a buyer's detriment for sure.
I agree with that. Hey, Chris, unfortunately, we're out of time. And I'm going to bet some of our listeners might be interested in selling their business, and some of them might want to get your wise advice. I looked at your website, and it looks like you guys have some really good tools to help people figure out where and who they might want to sell to. So, how would people find you?
They can just email me. It's Chris, CHRIS, at class6partners.com. And it's class VI, the Roman 6 partners.com. And, always happy to send tools out, send content, whatever it is. We love entrepreneurs and believe in what they're doing and always want to support them, whether they're clients of ours or not. So,
And what's your website URLs if somebody wants to check it out?
yeah, www.class6partners.com.
Cool. And I've got
Yeah.
two things I'd like you to do. The first one I've asked you about 415 times. That's to go wherever you're listening to this podcast and please give us an honest rating review. If you love us, give us 5 stars. If you hate us, give it 1 star. And I'll only cry a little bit when you do a 1 star, but if you do it, you got to tell me why at least. And the second thing is, is one of the things that I see with most business owners is they think their business is going to get them to retirement. The world that Chris works in, that might be true. The world that you live in, that's likely not true. There's 8 million businesses in this country, and only 4% of them have over 50 employees. Only 14% have more than 20 employees. So that means the vast majority of you guys have small businesses, and those small businesses aren't going to get you to retirement by themselves. So we've developed this process we call the Financial Freedom Accelerator. What it does, it says, where are you now on the road to financial freedom? And what strategies might you want to be pursuing that will get you to financial freedom, which will create excess cash that you can use to pre-fund your retirement before you sell your business or just close it down, which happens again way too often. It's easy to find out more about it. Just go to www.sustainablebusiness.co/freedom. That's www.sustainablebusiness.co/freedom. Check it out. If you want to have a conversation about whether it's a good fit with you, click on the Talk with Josh button. So this is Chris Younger. You're with Josh Patrick. We're at Cracking the Cash Flow Code. Thanks a lot for stopping by. I hope to see you back here really soon.